Hello friends, this is Raj Sastry from Raj Option Trading. Today is December 6, 2021. Let's talk about DocuSign. As you all know, DocuSign is in the software area. Everybody has probably used DocuSign at one time or the other. These guys are into signing, your mortgage papers or your legal papers and do it at the comfort of your own home. So with that, as you can see here, you must have seen somebody signing something that means everything to them. So it's a great slogan here, and it's an undisputed leader when it comes to e-signature. So stock came down big time after some concerns about growth slowing down. Let's take a look at this company and see if it's worth buying here. So with that, we'll do a company overview, look at the major exchange traded funds holding DocuSign, look at the competitive landscape in the software area, review a few charts, and do a quick deep dive, look at the financial summary and stock performance, and compare DocuSign to some of the other high octane stocks like Adobe, Dropbox, Workday, and so on and so forth. And then finally do a final verdict here and rank these companies. So with that, let's jump in and get started. As you look here, we got a lot of these exchange traded funds holding a good chunk of dockets and stock here. So this is a very well bought company by these big mutual fund and ETF companies, as you can see here. So nice, as you can see here, few funds like FDG here, nice 12%, $12.92 million stocks in the DocuSign, and we got iHack here, nice 30 million shares of DocuSign, and look, we got FDN here, nice 323 million shares of DocuSign. Overall, DocuSign is being bought by multiple of these ETFs here, including our friend Kathy Wood here. She's got a lot of this DocuSign stock in the ARC ETF here. So I think she also has it in ARC next generation here. So I think she's one of the strong believers in DocuSign, as you can see here. So with that, let's jump in and look at the competitive landscape here. As you look through in the software area, these may not be pure competitors of DocuSign here, but generally these companies are in the software area. So as you can see here, we got Microsoft, 300-pound gorilla here at the top. Nice sales and market cap is $2.4 trillion. It's hard to imagine Microsoft has gone so much under the leadership of Satya Nadella. As you look through here, it's done nice in 1 year, 51%. Low RSI, I would be buyer of Microsoft even up here. And then you got one of my favorite companies, Adobe. Adobe is a great company under the leadership of Shantanu Narayan. As you can see here, RSI is 55. You could buy this great company. It came down pretty hard as a sympathy to DocuSign. This is a competitor to DocuSign. They can also do e-signatures easily using Adobe. And this is a bigger company with a lot of products, unlike DocuSign, which is mainly document management. And then you got CRM, Salesforce.com, Mark Benioff's company. Great company here. Right now, RSI is 33, completely sold off. I would be a buyer of CRM here. Oracle, again, a great company here. Larry Ellison's leadership. We got Safra Katz as the CEO here. RSI is 35, great stock at a sale here. And we got a few more as you can scan through. All great companies. Keep watching the RSI levels, except for Intuit, all and probably Infosys. RSI is pretty much low for most part, and we got Synopsys and Palo Alto Network a little higher. But otherwise, these are all great stocks here. I would be buyer of many of these stocks at these levels here and slowly accumulate. And let's look at next slide here. As you look through here, we got more names. Datadog, great name here. RSI is 44. VMware completely sold off here, trying to make a move here in the near term. You could buy that one too. And we got app plugin, just $93 stock here, trying to make a move here. And we got our friend DocuSign stuck in the bottom here, $135 stock. Look, huge 42% drop on Friday. You might be wondering now, should I be buying now? Is it a falling knife? Is the sky falling over? What should I do? Let's jump in and look at that and go from there. So with that, let's jump in. And even I like stock like Bill.com here, great buy at these levels here. RSI is 29, tells the stock is sold off. If you're a put option seller, keep watching the IV percentile. High IV percentile and low RSI means you could sell some put options under the stock price and make some money that way. So with that, let's jump in and review a few charts. And we got DocuSign here. DocuSign, big down here. Look, all the way from $256 down to 135. Huge drop here. That's why you got to wonder, is it a good buying opportunity or what's the deal here? And look, DocuSign drop 42%. Nice sales growth and gross margin, and a little bit high, a debt on the balance sheet, which may be okay for this growing company. Look, volume is more than double normal volume. It could be good to look. And even Adobe fell in sympathy here. Adobe is a great stock here. If you're concerned about DocuSign falling further lower, go after Adobe and buy some Adobe. It's a great stock here. Came down big time in sympathy to DocuSign here. And then you got Adobe, like we talked about, great stock. Anytime Adobe falls down like this, it's a great buying opportunity. I would be a buyer of Adobe slowly and accumulate. And then you got Dropbox here. Dropbox is, as you can see here, it's been dropping like the name says, but the on the balance volume is pretty steady here. And as you see here, nice sales growth and gross margin, a little bit high IV percentile, which is okay. So Dropbox is also a good one here. We'll rank this as we go forward, but down big time, as you can see here. And then you got Workday here. Workday is a great human capital management software subscription play here. This stock also dropped big time, as you can see here. Workday, as you scan through here, nice sales growth and gross margin. This is trying to go higher. Even if when the market is dropping, this stock is going higher with the 1.5 times normal volume. I would be a buyer of Workday here at these levels and take it from there. And as you look through here, ZI, one of my favorite stock here. This company helps sales folks to sell to the decision makers by providing the company directory structure and help the salespeople to identify the real decision maker. So stock has been dropping off big time. On the balance volume is pretty steady after dropping here. And look, we got nice sales growth and gross margin here, and institutions are buying big time. So I think it's a good one to buy at these levels here. And we got Now, right? Now is service now here. A lot of companies need some asset management for their IT infrastructure. This is a great stock, trying to touch its 200-day moving average. As you can see here, on the balance volume is pretty steady. That tells you more buyers than sellers. And as you see here, nice gross margin and sales growth, and institutions are buying slowly. And as you scan through here, nice performance. I would be a buyer of this stock here. And look, 1.5, more than 1.5 times normal volume. And then you got Atlassian or Team. This stock went up after the earnings. Now it's coming down promptly with all this money going out of technology and the high growth names. This stock is coming down big time. Look, IV percentile is 100%. That means you could sell some put option or a put spread under the stock price and make some money that way too. And keep watching. Nice sales growth, nice gross margin, and stock has done great in the last 5 years, more than double normal volume here. I would be a buyer of a Team at these levels slowly and go from there. And last one is Asana. Asana is founded by a co-founder of Facebook. Stock is has done great, but off late dropping big time here, below 200-day moving average. At these levels, call me a buyer. It's a great stock here, nice 1 year sales growth here. Insiders are buying hand over fist. And as you see here, nice volume here, more than double normal volume. It's done great in 1 year, 151%. This is a great buy at these levels. You can slowly buy some Asana and take it from there. And let's look at DocuSign here and jump into DocuSign. From a background perspective, DocuSign, you might wonder, why should I buy DocuSign? DocuSign is the undisputed leader in the e-signature with a 70% market share. That tells you something about the company. They've been honing in on this e-signature and providing leadership there. And they also provide a broader contract lifecycle management solution, which is where big companies need some solution around this. And as you look through here, they offer a free trial. You can start free. I know a lot of people who use DocuSign for any signature, maybe lease management, maybe buying home, or any of these small documents. You can do it through DocuSign here. This free trial is a catchy one here. You can buy free and then you can expand. It's a typical land and expand type motion here. That's why a lot of people do some free trial, then convert themselves into a premium customer. And as you scan through here, we also have they have this market which is more of a green field. Folks come into DocuSign out of their paper world here and then stick with the DocuSign. Even as we go forward in the hybrid work environment, I could see folks going into DocuSign versus going to a bank or a notary or a closing office for closing your mortgage. Instead, folks would love to do it from their own home. That's the benefit of DocuSign here. Even though right now there is a little bit slowdown in their revenue here, I would still think there is a case to be made. DocuSign will be there for considerably long time. Folks want to sign the papers online versus walking into a physical building. So with that, you might wonder, what is this DocuSign? So as you see here, it's a agreement cloud. You can sign the papers online versus going to a physical building. They got over 1 billion users worldwide. That's a huge user base here. They got 1.5 million paying customers. I think as they convert this over 1 billion users to more paying customers, that's a good story that can be done here. And they got a lot of these Fortune 500 financial companies. Think about all these financial companies. They still operate in the brick and mortar world, and they can convert into e-signature type signature or agreement here. That will help DocuSign big time. And they got a lot of healthcare companies. These two areas are very highly regulated. The moment financials and healthcare trying to adopt DocuSign and the e-signature, that can be a great one for DocuSign. I think that's a good tailwind for this company. As you look through here, you might wonder why the stock came down big time. Look, last year with all this COVID scare, revenue went up, 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 up to the sky, as you can see here. But what happened? Right now, their total revenue, it was up at the 53% clip here, but it came down to 42% clip. But it's still increasing, but at the lower pace. That's why Wall Street freaked out here. Hey, what's going on? Sky is falling down here. Their revenue is at a lower clip than the previous quarter. That's why about 11% drop in the total revenue. Compared to the total revenue growth. Total revenue itself is increasing from 343 last quarter to 545. That's a nice growth. But if you look at the trend here, the revenue growth, from year over year compared to Q3 of FY21, FY20 to 21 versus Q3 of FY22, there is a drop here, around 11% drop. That's why stock came down big time. Wall Street really freaked out big time on this. Subscription revenue, same pattern here. They had a 54% growth, quarter over quarter, as we call it, from a previous quarter, which is the Q3 of Y20. But now it came down to 44%. There's a 10% drop in the subscription revenue growth. Even though subscription revenue up, revenue growth is down. That's why Wall Street freaked out there too. Those are the big stories here. Anytime you see some deceleration, and Wall Street freaks out big time, and you could argue, hey, you know what, working from home is kind of sort of done here. People want to go to the physical buildings. That's why their revenue came down a little bit. But I would say, from here onwards, it will stabilize. It may not be like previous huge growth like FY20, but I think more folks will stick with their e-signature versus going back to the old world of paper signature. So with that, as you look through here, there's a nice subscription revenue. That's a great story here. 97% subscription revenue here. And as you scan through here, we got enterprise and commercial direct, which is a huge chunk here. I think that's a good story. I would say it's pretty good. Let's jump in a little more into this stock and see if it's worth buying here, or what should we do. As you look through here from a customer base perspective, company doing something right here. They're growing their customer base nicely at a 41% compounded annual growth. That's a great progress here. And their enterprise and commercial customers, who are the bread and butter, it's growing nicely at 52% compounded annual growth. So I think it's a great growth story. They're acquiring their customers at a nice clip here. That's always good. As you look through here from a background perspective, DocuSign, everybody kind of, say, did you DocuSign a document? DocuSign is becoming a verb here. It's a great e-signature solution here. They also offer CLM and automate workflows for the entire agreement process. It's a, undisputed leader with a 70% market share. $135 stock here after this huge big drop on Friday. Market cap is around 26 billion, as you can see here. Analysts are saying moderate buy at this time with the 8 with the buy rating, 5 hold rating, and 1 sell rating. Stock keeps falling on Friday. Kathy would bought a lot of DocuSign stock here. As you look here, we got, folks are wondering if there's an opportunity with the DocuSign after this 26% drop here. And, it had a worst day on the record as one of the biggest SaaS, pullback here in the recent memory. So this is why you could make a compelling case on DocuSign here. Given you could wonder this huge drop from 226 all the way to 145, is it warranted? Did Wall Street freak out? What should we do? And also, if you're a little bit skeptical about DocuSign, I would say Adobe is a great one here. Because of the DocuSign huge drop here, Adobe also came down in sympathy. That's a great one to buy at these levels. And as you scan through here from a leadership perspective, we got Dan Springer as a CEO here, and we got Scott and Joanne. Let's look here, nice CEO approval rating here. Out of 1,153 ratings, 95% approved the CEO here. That's a huge rating. I think Dan is doing something right here. That's why it's a nice approval rating. Leadership checked out because, checks out, give a nice approval rating here. And as you can scan through here, he's leading the company, and he want to make everything digital when it comes to agreement. And he's got a lot of relevant experience, 30 years of experience. He has been with the DocuSign for a while here, and below that he was with the Responses and few other companies, and he was also consultant at McKinsey. I think his background checks out here. He's a great leader with a nice approval rating here. And as you look through here from a deep dive perspective, look, price is 135 after the huge haircut on Friday here. And they got, short float is very low here, 3.23%. Market cap is $26 billion. They're down 57% from 52-week high. And as you can scan through, their below their 52-week low here. Target price is 246 right now, which is about $100 more than current price, more than $100. So relative volume is 33 times more than average 3-month volume. That's a huge volume surge here. So with that, as you look through here, nice gross margin. I love this. They also have nice sales. Sales growth is nice. Sales growth, I think this is probably it does not include the recent quarter, but nice sales growth as you can see here. They also have a nice year-over-year sales growth, and operating margin right now is negative, and net margin is negative, meaning company not making money, but nice gross margin. All these early stage companies, they focus more on their own product. They don't really focus on showing a profit to Wall Street. And as you scan through here, nice price to sales ratio, not too much here, it's manageable. And RSI is 13. That tells you stock is clobbered here. It came down big time. And from a next year perspective, there is a nice earnings per growth for next year, and there is also nice sales growth for next year. Even though in the near term, both earnings per share as well as earnings per share growth is negative, longer term analysts are predicting nice earnings per share growth as well as sales growth. And as you look through here, debt to equity ratio is a little high. I would like to see this a little bit lower, but I think this company is trying to take advantage of this lower interest rate situation here. I want them to reduce this a little bit. As you look through here, from a RV percentile perspective, it's 100, meaning you could sell some put options or put spread beneath the stock price and make some money that way. Understand it's a little bit high risk, high reward situation. And as you scan through, they got some positive free cash flow here, but RO or return on asset and equity both are negative. I want them to turn around and improve that situation here. And finally, look, performance perspective, huge drop, 42% in one day. That's a huge haircut. I would probably, look at this company a little more closely and see if it warrants a, buy of the stock here. And down big time in 5 days, 6 months, 1 year, but 2 years is done nicely. And as you scan through here, I think they're doing pretty okay in 2 years. And institutions are owning still 78% of the company, and institutions are buying slowly, as you can see here, even after this drop. That's why I think it's probably a stock worth looking at and see if we can buy at these levels. So with that, when it comes to numbers, as you can see here, it's the annual numbers. Look, it's trending in the right direction. I would say I would love to see this a little bit lower here, but still I think overall it's doing okay from an earnings per share perspective. After the huge drop in 2019 in the earnings per share, now it's stabilizing. And from a revenue perspective, this company knows how to grow the top line. Nice top line clip, as you can see here. It's a good sales growth. And when it comes to shares outstanding, as you can see here, it's manageable. If the sales is growing at this clip here, a little bit higher outstanding is okay. This is not out of the woods. And as you look through here from a quarterly revenue perspective, it's a nice quarterly revenue clip. Even the latest quarter, they increased the revenue, but the percentage of increase was not as much as expected. That's why Wall Street freaked out. But nice quarterly revenue clip here. I like this one here. And they're also spending good money on the R&D here. I love companies spending money on R&D. This company is spending money on R&D to keep their product very compelling. And from a net income perspective, they're trending in the right direction. As you see here, from a 26 million negative, it's 6 million negative, so they're trending in the right direction. I think overall from the numbers perspective, it checks out. Even though there is a deceleration in the revenue growth here, revenue itself is going higher. I think probably it's worth looking and compelling. And as you look through here from an earnings history perspective, as you see here, we got DocuSign, nice market cap increase here, 9 billion, 11 billion, 58 billion. But now after this huge haircut, it's about 26 billion, almost more than 50% haircut here. And as you look through here, sales was 545 million in the latest quarter compared to 512 in the previous quarter. 42% increase in sales, which is not bad at all. But compared to what they've done in 2020, this was a little bit not great, but they've done nicely. They increased their revenue despite of this aftermath of COVID, working from home environment. And as you look through here from a cash perspective, they got a nice amount of cash here there, which is very good here. And as you scan through here from a cash flow perspective and gross margin perspective, even in the latest quarter, they increased their gross margin. That's good. They also have a positive operating margin. That's also good here. And they're spending good money on R&D to improve their product, which is always good. And as you look through here from a return on asset and equity perspective, right now they're negative. I want them to turn the situation around and be positive here. And now let's look at price to sales here. Price to sales is not bad here. I think it's not very expensive after this huge big drop here. So overall, their numbers look good here. Wall Street probably freaked out big time here, but company is growing. So with that, if you look through here, this one kind of tells you about the earnings history. Does not have the latest one. This is from Seeking Alpha, as you can see here. But overall, this company does not surprise too negatively. That's why after folks saw the big downtick, folks kind of freaked out here. Wall Street freaked out. That's why stock came down here. And now let's look at analyst upgrade and downgrade here. As we scan through here, we got a lot of analysts downgrading on Friday here. What do you expect when the stock drops big time? Everybody comes in and downgrades. But look, we got JMP Securities and Citigroup upgrading the stock here. Even though price is dropping here, but much ahead of the current stock price here. So that's a nice upgrade here, or from both JMP as well as Citigroup here. And let's look at few more here and go from there. So from an earnings transcript perspective, I think company beat by 12 cents here from an EPS perspective, and from revenue perspective they beat by 14 million here. That's a good beat here, even though it was not up to the expectation of the analysts here. And great financial result here. Revenue grew 42%, and they got a nice 22% operating margin here, exceeding the guidance. International was a bright spot here, nice growth in the international, 28% year over year growth. They added a lot of new customer base here, and also net retention, it's 121%. That's a great number here. And they had some market dynamics here, where 2020 was the year where most people nested at home. They used DocuSign, whereas 2021 folks are moving around. They are not afraid to go to physical buildings. That's why the previous boost that you saw in 2020 is kind of dropping off a little bit. That's one of the reasons why there is a little bit deceleration here. And as they move into Q3 of next year, they saw some Q3, which is previous quarter, they saw some demand slowing down here, because customers are moving around. They are not nesting at home like 2020. And there is still great opportunity in the agreement cloud here, and they want to capture and go after this and have this $50 billion agreement cloud. And as people go into the office here, they will still go and do e-signature. Some habits will be continuing. Folks don't want to go back to the paper world. That's why there is a good play here. And they also have nice $59,000 new customers they added in Q3. That's also great. They're also teaming up with Microsoft here, and DocuSign is the de facto signature platform for Microsoft Teams. That's a great one here. Companies partnering nicely. So with that, overall, I think stock has done okay. I mean, understandably, this is not 2020. People are moving around. There is a little bit deceleration, I think that's what spooked the Wall Street here. At least I think it's a good one to slowly start buying. Can the stock go a couple dollars below? Yes, they can. It can, but I think it's a good buy at these levels here. And let's look at performance here. Look, 39% drop in 2021, but has done nicely for 2018, 2019, and 2020. I think stock is a keeper here. We should take advantage of this huge big drop. And if you look through monthly performance, look, 45% drop in 1 month. It's a huge drop, but more greens than red, as you can see here. And whenever they drop big time, they always bounce back nicely quickly. I think this might take a little bit time, but I think it's a good one to slowly accumulate and build your positions in DocuSign. If you look at the weekly performance here, huge big drop here, but in the past all the drops are good buying opportunity on this stock here. And if you look at the daily performance, huge drop on Friday here, could be a great buying opportunity. And if you look through the 3-year chart here, stock has been doing nicely here. Look at 2020. It's a COVID-19. Folks stayed at home. Everybody signed the mortgage papers. With all the people moving from cities to suburbs, all these mortgage and leasing done through DocuSign. Stock went up and up. But now see here, 2021, folks are moving around freely, and stock drops really free fall here below 200 week moving average here. I think this could be a good buying opportunity here. And as you scan through here, look, it's a 1 day, 1 year chart here. Stock dropped from 232 to 135 in a heartbeat here. I think it's a good one to slowly buy. No need to rush and buy huge amount, but slowly keep adding. It will come back nicely. Look, implied volatility went up big time here. You could sell some put spread under the stock price and make some money that way. And look, chart is ugly right now. DMI chart, red line shooting to the sky here, blue line coming to the earth. That tells you completely bearish at these levels. That's when we jump in and make some contrarian bet and buy slowly. And from an option chain perspective, stock is at $135, as you can see here, down $98. And look, $135, there is a 260 open interest, volume here. As you scan through here, we got a nice volume, at 140, nice volume at 200, and so on and so forth. And if you look at the put side, put side also, there is a good volume, as you can see here, but probably not as much as a call volume. And that makes our put call ratio as 0.8. That tells you there are more call buyers than call traders than put traders. That's why put call ratio is 0.8. And look here, VWAP is 140, stock price is 135. That tells you stock wants to go at least to 140 pretty quickly here. So with that, I think it's a compelling buy at these levels here. More call options traded than put option. A little bit higher PC ratio, but not, it's below 1, which tells you in the option market, folks are betting this stock will go higher. And now let's compare and do some ranking. I know many of you love ranking. Let's see, compare these stocks here. DocuSign, Adobe, Dropbox, Workday, Zoom Info, ServiceNow, Atlassian or Team, and Asana. So with that, from a stock price perspective, as you can see here, DocuSign is $135 after this huge haircut on Friday. Adobe is $616, and so on and so forth. And look here, enterprise value perspective, all these stocks are fairly valued. Their enterprise value is really above the current market cap, as you can see here. I think really, I think I would say at these levels, stocks are a little bit undervalued, given enterprise value is really higher than the current market cap. So even if you sell the company, you'll get more money than its market cap here. Nice trading volume. These are trading very nicely here. Liquid stocks you can trade in and out, and also nice 3-month trading volume here. So overall, these are all great companies, as you can see here. And from a analyst recommendation perspective, analysts have got strong buy or buy recommendation on these stocks here. Look, Adobe has a lot of analysts following them, and even DocuSign has got a lot of analysts following. And same story with Workday and ZI, ServiceNow, as well as all these companies got nice analyst recommendation here. And as you scan through this year, we got two holds for DocuSign here, which is after this huge big drop, there may be more coming in our way. Look at the target price. All these stocks have got nice target price. Adobe stock price is 135. Sorry, DocuSign stock price at 135. Target price is 246. That's a nice target price, above 100 from current levels here. And as you scan through here from a 52-week change, this stock dropped big time, below 57% from 52-week high here. And look, Adobe also dropped in sympathy, and so on and so forth. So overall, I think all these stocks are doing well. Both DocuSign and Adobe and Workday, ZI, Now, and Asana have got strong buy rating from the analysts, and a lot of analysts are following these companies. And as you look through here from a fundamental perspective here, a nice quarter over quarter revenue growth for all these companies, with probably exception of Asana, which is a little bit newer. But I think all these companies have got nice sales growth. And they also, as we look through here from a fundamental perspective, from a gross margin perspective, nice gross margin for all these stocks here. Highest gross margin for Asana, as you can see here. Next is Adobe, and probably the next is ZI here. From it, when it comes to net margin, Adobe is making money, nice 38% net margin, and Workday is barely making money, and ServiceNow is also making some money here. And free cash flow positive. All of these companies are free cash flow positive, with the exception of Asana here, which is a little bit newcomer here. And they do have a lot of cash, as you can see here. And Adobe is a cash cow with the $6 billion cash here. I think overall companies are doing well. And from a debt perspective, debt to equity ratio, a little high for our DocuSign. I want them to reduce this a little bit, but looks like Adobe has a low debt to equity ratio. That's great. And from a price to sales ratio perspective, even up here, DocuSign is a little bit expensive, but not as expensive compared to Atlassian and Asana here. And as you can see here, right now, Adobe and even Dropbox, Workdays, they all have lower price to sales ratio. That tells you valuation perspective they're doing well. From an earnings per share perspective, Adobe is profitable company with a positive earnings per share. Same is the story with Workday, ZI, ServiceNow. Other companies are not making money right now. There is no earnings. That's why it's negative. And now let's jump into future growth. We all care about the future growth, not just the current growth. From a future growth perspective, next year revenue growth is positive for DocuSign and Adobe, as you can see here. Nice earnings per share. And Adobe has got a nice return on asset here, ROA and ROE, that tells you this company is more profitable. And revenue growth for next year, nice revenue growth for Dropbox, Workday, and so on and so forth. All these companies have got nice revenue growth for next year. But when it comes to this year, after this huge drop, one more quarter to go, DocuSign has got negative earnings, and Dropbox is huge, big negative, and so on and so forth. So with that, now we'll jump in and look at technicals here. From a technical perspective, I know many of you love technical analysis. Right now, DocuSign is sold off with the lowest RSI here. And when it comes to money flow here, which is a volume weighted RSI, it's again low in DocuSign. And as you can scan through, even Workday is much lower than that. It's a good buy. Dropbox is much lower. And even Team is lower. Asana is lower. I think these stocks with a lower RSI and lower MFI are good buying opportunities from a technical perspective. From a put call ratio perspective, folks are hedging and buying some some DocuSign stock and even Adobe stock. Even Adobe has got more puts traded than calls. That tells you folks are hedging and making sure if the stock drops, they want to make some money. And as you look through here, we got short ratio highest in Team and Asana. These short sellers are breathing down Team and Asana's neck here. They want stocks to go lower. So now let's jump in and look at a few more things here. The past performance look. Uh, it's a bloodbath in DocuSign here. Huge drop 1 day, 1 week, 1 month, all the way to 1 year. But it's done good in a 2 year time frame, 93%, even after this huge drop here. Adobe fell in sympathy. As you can see here, down 6%. I think it's a great stock. Adobe has done great in the last 10 years. You've done great if you bought some Adobe and held on to it. And Dropbox, a huge big drop here, done okay in 1 year and 2 year, but nowhere compared to Adobe here. And Workday is also great here. It came down off late with all this rotation out of high growth names here. If you look at the performance here, ServiceNow has done great. Atlassian has done even great, but there's some temporary weakness. Even Asana is a great one here. So weakest one here probably is a Dropbox when it comes to past performance here, but other stocks have done great. And now let's look at moving average. I love looking at simple moving average. Look, Adobe is really above its 200-day moving average by 8%, and even Workday, ZI, now they're all just above their 200-day moving average. Those are the good candidates, and they're trying to turn bullish here. So I would focus on those candidates here. But DocuSign and Dropbox and even Asana here, these are stocks that are coming down big time. I think as a contrarian, you could buy a small position here and hang on to it. And now let's look at comparison. I think I know most of you love to compare these names here. Look, we got DocuSign, Adobe, Dropbox, Workday, ZI, and so on and so forth. Keep watching here. All these stocks have strong buy or buy rating and nice 1 year growth here from a performance perspective. Except DocuSign here, all these stocks have got positive 1 year return here. And as you scan through your nice revenue growth and quarter over quarter gross margin, nice gross margin and quarter over quarter revenue growth, handily beat rule of 40. I think it's a good one here. From a net margin perspective, Adobe is making money, and Workday and ServiceNow, they make money here, but others are not making money yet. And now let's look at some of the rankings here. As you look through here, these are the rankings from premier industries, companies like Morningstar. Look, financial health perspective, DocuSign gets a B. That means they have enough money. These guys are not going to go bankrupt. And they also get a high Altman Z score. Anytime Altman Z score is above 1.8, that tells you company is solid from a financial perspective. And they got Piotrowski F score as 5. That tells you their accounts or financials are improving. So overall, don't worry about financial health of this DocuSign company. They're doing great. But in the industry rank is 7, growth is D after this huge drop here. So I think this is where from a growth rank, profit rank and quality rank, it's a little bit lower compared to other names here. So that's why I would allow Adobe more at these levels, given it's got ship shape all blue here or all green here with the B financial, nice Altman Z score, the financial health here, nice Piotrowski score telling you their accounts are improving, financials are improving nicely, leader when it comes to growth here, and leader when it comes to profitability, and leader when it comes to quality. It cannot get better than Adobe here. It's a great buy here. And Dropbox has to improve their financials a little bit here. I love Altman Z score above 1.8. Right now it's below 1.8. Not too bad, but they have to improve their financials here. And they also get an F for profitability. Workday is a great one here. They're doing nicely here. A in the financial health, B in the growth, and as you can see here, F in profitability. But industry rank is pretty good, and quality is also pretty good. ZI also doing pretty nicely here. I think it's overall nice. Financials is not ship shape, but it's still okay. Service now is doing great here. F rating when it comes to profitability, along with the team here. Asana is a newcomer here. I think it's also doing well from a financial perspective. From a growth, it gets a D, and industry profit rank gets a 8. Looks like they're not focusing on the profitability yet. So with that now, let's look at the ranking and go from there. Look, undisputed here, Adobe number one, doing great, great, great here. After this sympathy drop, I think I would be buyer of Adobe here. Number two, Workday. Look, Workday has got nice numbers here. Ship shape, financial health here, and industry rank is 3 here, and quality rank is 4. It's number 2, and number 3 is ServiceNow here. ServiceNow also has nice financials and nice industry growth rank here. That's number 3. And number 4 is Team or Atlassian here. Atlassian is also doing great from a financial health perspective, and they're also doing well from a industry profit perspective. And then you got your ZI Zoom Info, not to compare with the Zoom video. Zoom Info is a nice one here with the 5 as the rank here. Nice, Altman Z score above 1.8. And as you scan through here, nice industry profit rank here and quality rank. And number 6 is Asana. Asana, as you can see here, newcomer here. Stock dropped big time from 52-week high. Stock dropped big time off late. Negative net margin, as you can see here. But look, it's doing pretty well from a financial perspective. Nice score when it comes to Altman Z as well as Piotrowski score. That gets number 6. Number 7 is DocuSign, the stock which we are looking at right now. Huge, big drop right now. Still nice from a financial perspective, and they're doing well from a Altman Z score. Indicates financial health is sound. Piotrowski score here indicates their books are pretty good here when it comes to financial, but profitability is F here, given company not making money yet. That number 7. And number 8 is Dropbox. Dropbox has to improve their financial situation here. Gets 1.8 in Altman Z score. I love to see companies with above 1.8. And profitability is F here. That's why number 8 is the Dropbox. So with that, you might wonder, okay, good, what should I do now? So I would say, DocuSign as a banner year last year with everybody nesting at home. Right now, last year remote work was the rule here, not an exception. And, stock went up 200% last year. It's a clear leader in the e-signature with the 70% market share here. And folks love their free trial here. They do a free trial and convert the customer slowly into premium customer. And as the stock came down here big time, with the worry of deceleration and folks not returning, not doing as much e-signature, stock came down, and Kathy Wood bought a lot of this DocuSign stock on the Friday drop here. And according to the company here, they are seeing a solid growth of 42% revenue growth year over year. Even though revenue growth decelerated, they had a nice 42% growth, and they're also giving a nice operating margin here, 22%, exceeded the guidance. International sales was great here, 68% year over year growth, and they also they're expanding their customer base nicely, as you can see here, and very good net retention rate. On the negative side, as you see here, they are seeing some demand slow down here, and some of these buying pattern temper as more people travel versus sitting at home and signing the papers. I would say stock is oversold here. Wall Street overreacted. I would be slowly buying this stock and accumulating. Can it go a couple dollars lower? It can, but right now it's at a great point. We could slowly buy some of this company and sock it away and revisit at a later point. So with that, I would recommend buying this stock slowly and slowly accumulate. So with that, thank you very much. Happy investing and trading. Please subscribe.